Okay, hello everyone. You should be able to see me now. Let me know if not, or if you can't hear me clearly. So thank you very much for joining this conference call. You should be able to see on your screen just a quick agenda of what we're going to be running through. I'm not going to spend too much time going through who I am and my background, etc., because I believe most of you already know that. It's nice to see some familiar names here in the among the participants. So feel free to ask later on, maybe in the Q&A section, if there's anything else that you would like to know about me. In just a couple of lines, I've had quite a varied career mixed between consulting and finance, and I've been trading in one way or another since I was a teenager. So that's already 15 years or so now, and I'm now doing this full-time with eToro. So let's just move on to a quick high-level view of what's been going on. So the structure here is I want to start from a very high-level view and then kind of zoom in both in terms of my performance and also the markets. So the chart that you see on the right is comparing my portfolio's performance on eToro, the green line, to the S&P, which is the gray line that you see below. So we do have quite a bit more volatility, although that has been reducing in recent years. But as you can see, we are absolutely destroying the S&P 500 index overall. So I think this is always something which is important to bear in mind, and I have to constantly remind myself of as well, that investing is really a very, very long-term game. And we're talking years, really. So even though the individual days or weeks or months can be very eventful or very interesting or very emotional, you really need to always zoom out and look at the longer term picture. So you can see we're still doing very well in the last 12 months, year to date, 27%, 41%, and over 500 since I started in 2014. The last few months have been a slight loss, and we'll dive into that in the next few slides. I also just wanted to say that I'm very thankful and frankly also impressed with the ones of you that a lot of names that I recognize that have been around for quite some time, because I realized that especially in this kind of market, it's not easy to be contrarian. And that's something that has always been kind of part, I don't know if deliberately or not, but I always seem to be on the contrarian side of things. So when the market is extremely optimistic and most of the PIs are heavily long, it's very interesting that a lot of you, or all of you in this case, would be copying me as well, even though I'm not long. I've been neutral / short. So yeah, I realize that can be challenging at times, but I've found that in the long term, usually being in the most crowded trade is not a recipe for long-term success. So as I said, starting from a very high-level picture, this is a chart showing you the Nasdaq going back to the 1990s. And you can see the parallels that we have here with our current market action. Specifically, if you look at the MACD indicator down here, we have something that I really didn't think we would ever see, frankly, which is higher readings than what was happening in 2000, where the market was just unbelievably optimistic, but we seem to have exceeded that. It's hard to say why exactly, but we have done. So I think the thing to take away from this chart and from the general market at the moment is not so much a judgment of a directional judgment, let's say, even though I do have an opinion on that, but more one of extremes and mean reversion. So if you look at a lot of the things, a lot of the indicators, like the MACD, for example, as I mentioned, but also other things like the volatility in the bond market, which is at absolute historical record lows, is usually a sign that we have reached an extreme. And as you know, extremes are unsustainable. Same with these dollar short positions have been incredible. So this tells me that we are at an extreme, and at some point that is going to revert, right? So there's not an intrinsic judgment there in individual stocks or markets or market value or anything like that, but just an observation that we are an extreme. And as that market sentiment has been so bullish and optimistic, I would definitely say that that is a representation of the extreme, which is in the near future going to be reverted. And then you can see other similarities in the technicals as well. This is a weekly chart, by the way, and you have this classic ascending channel, which then has a breakout to the upside, which is often known as a bull trap, which then takes you to the absolute high before you head back down. So it's hard to know if we're there exactly now, and that's not what I'm trying to call, but I think we're close. And so, as I've said again and again, I think the risk return of being long here is terrible, because the upside, even though there could be some more, is bound to be very limited. Yeah. So this is zooming in a little further. So this again is the Nasdaq from this dip that you see here on the left side of the chart, is the crash that we had in March and April. And then this channel that you can kind of see in the previous chart as well. And the thing that is very interesting about this week, or even today actually, is that we have what's known as a retest of this channel. So having fallen through it after this, I think it was September 2nd or 8th, early September top, took us right down here. And the market will often attempt to re-enter in its previous trajectory. And if it gets rejected here, meaning it doesn't manage to break through, then that is not only a bearish sign, but it also ends up being often a bit of a self-fulfilling prophecy. The other thing to note is the volume, which is this kind of histogram thing that you see down here on the lower side. And you can see the selling volume, the red volume here on the high was just very, very meaningful, extremely high when compared to almost any volume in the visible past. Whereas this rally that we've seen back into the retest is really very low, and often a rally on low volume is kind of considered to be that kind of running on fumes, if you will. So I would lean towards, and I'm keeping a very close eye on it, thinking that we don't pass through here, but I'm going to wait and see for some kind of confirmation before I take action on that. The other interesting thing to note here, which ties into what I was saying on the previous slide, is that this correction here that we saw in September, despite it being quite dramatic in its nature, it was very fast, and as we mentioned, a lot of volume. The sentiment that went with it, this was kind of sort of 10% drop or something of that magnitude, really didn't shift sentiment at all. So we went from extreme optimism to essentially neutral here. Whereas with that kind of shift, you would usually expect sentiment to flip on its head, going from very optimistic to pretty fearful down here. So that tells us that the market is basically complacent, and people have become kind of blindly optimistic. Again, a sign of being in quite dangerous territory. So what I'm doing here is I'm maintaining a fairly neutral stance. As you can see from my portfolio, I have quite a few longs in stocks that aren't as exposed to this huge optimism, which is mostly tech. And then some shorts, and they're mostly balancing each other. And I am basically waiting for a clearer picture here. I think there's going to be some kind of catalyst, which is unknown at the moment. It might be triggered by an election surprise, or it might just be a sell-off that triggers a cascade of liquidations, that kind of thing. Or it could also be to the upside, that while I think it's less likely, it's definitely possible. We could have further upside, but I think it's clear to put that in the context. It's important to put that in the context of, I think that would be further upside within this blow off top that we've seen. So it could run into the end of the year, but I still definitely maintain this this more bearish longer term picture. I don't think anything has really changed in that respect. It's a little hard to trade in the shorter term, but as you will have seen from my trading style, I tend to have constant exposure with quite low risk that often has a small cost to maintain that position, but once it hits, it has a very high payoff, like in March. Finally, I just wanted to touch on Bitcoin, and that affects crypto more generally, as that is quite a significant part of our portfolio. So without going into too much detail here, we had a very, very important breakout that I mentioned in the last call as well. And some interesting news in this quarter was the institutional backing, which it's hard to overstate how important this is, because with most markets, it's really like a shift in gears. Moving into institutional backing space leads to a cascade of investments. So after MicroStrategy investing close to 500 million, and it's not just only an investment, it was literally on their treasury, on their balance sheet. Square quickly followed suit, and I imagine that there's going to be more to come. And this is where the real volume is. So once this really picks up, I fully expect to see a very strong bull run in Bitcoin and cryptos more generally. So I'm going to remain very bullish on that, unless we see some kind of surprise significant movement back into this, under this trend line, under the sort of I think that's about $8,000 level. I think that's all I wanted to cover for today. I wanted to keep things quite concise. I'm aware that you're probably very busy people, so hopefully that conveys my main ideas and messages here. And I wanted to make sure that we have plenty of time for your questions. So over to you. Feel free to unmute yourself and turn your video on if you would like to ask a question directly, or you can also ask it in the chat if you would prefer that. Thank you.
You have a first question in the chat.
Yep. Okay. So the first question is, what do you think will be the early signs of the catalyst which would cause a crash? So the early signs, it's hard to say, because by definition, the catalyst is the initial move or the initial action that is almost invisible. that then causes the more visible results. So the clearest way to look at it is basically the charts, the technicals. That shows you that is a very truthful, unbiased picture of what is happening. So if you suddenly see selling volume picking up, the market's dropping off at an unusual speed, that kind of thing, that is going to be a sign that things are really starting to move. But those are post the catalyst, right? The catalyst is hard to know exactly what it's going to be. It could be, like I mentioned, something in the elections, or something to do with COVID, or even something just more random, you know, some very big player taking a very big position that changes things. But the way you will really feel it is when the sentiment changes. So you're probably aware, just from friends, family news, that everybody is buying Tesla and Zoom, and all these people that never usually trade are making very easy money. When you start to hear in the general, in the elevators, so to speak, that people are losing money, or that things are not looking so rosy anymore, that's when you'll know that we're on the other side of the top, although that will probably already be quite a way into the drop. So I hope that answers your question. If not, feel free to clarify. Okay, next question. Is it right to add funds? Is it the right time to add funds? So this is really dependent on you. What I would say is the optimal time to add funds is usually the opposite to when most people do it. So psychologically, most people will be tempted to add funds and increase their positions when things are already going very well. But by definition, the better things are going, the less upside there is likely to be, right? So you kind of see that, you can see this parallel in the markets as well. The better things go, the more money people put in. So I had a lot of people adding lots of funds in March, for example, which is understandable, but it would have been a lot better if they had added it in February. So my answer would be, if you are here for the long term and you understand and agree with my general approach and strategy, then yes, it would be a good time, because the real bear market has not even started yet. And so you want to make sure that you are invested as much as you want to be before that, so that you can reap all the benefits from that when it eventually happens, if it does the way we're expecting. So it really depends on how confident you are in my approach. Yeah. Okay, 2 questions from Ortega. Why not to follow the market until it drops, controlling with stop losses? One thing that is very hard to understand until you really trade yourself, and it's also a bit of a psychological bias, is that the market is, you can only really make these kinds of statements or questions in hindsight, because there have been a lot of drops on the way up. So take September, for example, or some smaller ones before that. So would that be the point when you stop being long, or would it have to be, so if it had been, then you would have missed more upside. If it hadn't been and the market had kept falling, then you would have been on the wrong side of it. So it's very hard to simplify it that much. I see what you're saying, but going back to my first slide, I think it's very important to have a long-term plan and conviction. because otherwise what you end up doing is just reacting to the market, jumping around, going long, short, and it's much harder to be successful that way. So up until the beginning of this year, I had been purely long for years, and you could see it went very well. And I was investing in companies that I was very confident in their future, like Tesla, back in the day. I'm talking 2015, 2016. And despite the ups and downs, it's kind of the opposite of now. I just held on because I knew that the fundamentals were there. Now it's the opposite. I believe there are all these things that are incredibly overvalued. And so I'm just holding the shorts, and I'm pretty confident that eventually things will unravel. And I don't really mind if in the meantime it goes a little bit higher, a little bit lower. You just need to take the position and stick to it. The most important thing is to have that clear reason and that clear conviction. I saw somebody tweet actually that you can copy somebody's trades, but not their conviction. And that's very true. And it's a very important thing to remember. So it's important that if you're copying me or anyone else, you really understand what their ideas are, what their plan is, and that you agree with it fully. So that even in difficult times, in testing times, you will be able to stick with it and not risk jumping out at exactly the wrong time. Second question from you, and then I'll jump to the previous ones. Do you think people stop following you due to results or lack of communication? I really don't know. I imagine there's a whole host of reasons. Judging from the movement in number of copies from the data that I can see, I think people are probably way too short-sighted. So a lot of people left as soon as my performance stopped being constantly green. And there may be people who want more communication. I'm not really sure. But generally, it seems to be that people, as I was saying, just weren't fully on board, didn't really understand the plan, and therefore weren't able to stick with it. But yeah, that's just my interpretation. So you as copiers probably have a better idea of that than me. So happy for you to shed your some light or share your opinion on that if you'd like. And by all means, if you're implying that you would like more communication, I definitely take that on board. Question from Jinesh. Why are stocks, crypto, and USD all linked? If you're asking about correlation, I think there are some very complex mechanisms in there, and so it's definitely not one variable only, and it's very hard to untangle all of that. There can be various theories as to that, but in a market like this that has been heavily one-sided, that's usually the reason. It's just sentiment that is really driving everything. How long do you think the time frame is where we see the catalyst? Okay, that's a good question. So it is hard to know exactly, but based on what just my opinion would be no later than the end of the year or very early next year. I think that with the election and with this kind of COVID wave 2 happening, there's definitely room for catalysts. And then the flip side of that is that the more, not the flip side, another point is that as the market keeps rising, there's going to be more and more of the smart money that is getting out closer and closer to the top. And these levels that we're reaching are by definition unsustainable more than a certain amount of time. And we're already very high up in that unsustainable territory. So it really can't be that long. And you know, just a caveat, that doesn't necessarily mean that there's going to be some dramatic crash. It just means that these kinds of indicators, metrics, sentiments just do reset, right? They do mean revert, they oscillate. So they might do that even with a smaller drop or a period of choppiness in the markets. It's not necessarily just going to be off the side of a cliff, although it is looking more and more likely. And the higher you go, then the more extreme the optimism is, the more dramatic. Just imagine it like a spring, right? The more you pull it or the more you compress it, the more you're going to get an equal and opposite reaction. Question from Jonathan. It's good to see a lot of questions, by the way. Thank you. Do you think that the complacency in the market at the moment comes from the large volume of new and inexperienced traders out there? And if so, why shouldn't it continue? Okay, it's a very good question. So I think part of the complacency does come from that. So the ease of access to the markets these days, if you look at eToro or other, like Robinhood, which has become kind of the synonym of these sort of inexperienced traders, but more broadly speaking, they tend to be defined as a retail trade. So not pension funds, hedge funds, you know, not all of these longer term, more sophisticated money. There has been a huge influx of them due to the ease and cheapness and access to markets. And they have actually become, I think, don't quote me on this, but I think I read that they account for like nearly a third of the market, something along those lines. And a few decades ago, that was more like 5%, 5 to 10%. So they do have a much more significant impact. And that might be why we're seeing record levels of euphoria, your record levels of inexperienced behavior, let's say, which is understandable. You know, if you join the markets and everything is just going up and everything seems easy, then that is the whole, the entirety of your investment experience. You kind of just assume that that's how things work. So why shouldn't it continue is also a very valid question and a very interesting one. So it could continue, but they're still not the majority of the market, right? So as this does continue, as there are more and more extreme indicators and record-breaking conditions in the markets, the more experienced money, which is still the majority, is going to be rebalancing, shifting, and pushing in the other direction. And there's going to be more and more speculation to the downside. And again, it's a very complex, multivariate problem. But usually these things just work. Like, I think Bitcoin is just an interesting analogy for your point specifically. So if you think of Bitcoin back in 2017, it was mostly driven almost entirely by this kind of trading. So why do you think that it didn't continue past 20K? you reach a point where even the inexperienced traders start to cash in, and things just do turn eventually. Question from James. What are your thoughts on the upcoming election and how that might affect the markets? So I'd say I don't have any strong opinions on the election, but some movements in the market can help you to infer what they're pricing in. So you see some of the solar stocks, for example, really rocketing. Little things like that kind of hint to the fact that the market might be pricing in a Biden win. So if that's the case, because it's just a hypothesis, if that's the case, and then Trump wins, for example, that might be a huge upset to the markets. I'm not sure. I think it could go either way. I think it's still pretty close. And what was the other point I wanted to make? Okay, I'll come back to it. I've forgotten, but I'll come back to it. But yeah, broadly speaking, we'll see. It's just a moment where it could go either way, but as it is a very black or white result, that can be something that just triggers moves. Oh yeah, I remember what I was going to say. So I think part of the market's expectations to do with the elections are also tied into the policies, right, that would be tied to the winning candidate. And a narrative that we've heard again and again is around liquidity, around stimulus from the Fed and how that's driven the markets, et cetera, right? And I feel like this is becoming a bit of a dangerous narrative because a lot of participants in the market assume that once there's more they assume there's going to be more stimulus coming on an ongoing basis, and they assume that that is just going to continue to have an impact. Whereas if you look back to around 2008, there was many rate cuts by the Fed and continued stimulus throughout that whole GFC, throughout the whole crash in 08. And the market dropped whatever it was, 60%, even throughout all of that stimulus. So while it may have worked in these specific conditions, I think the market is being a little complacent and a little naive around this assumption of, yep, stimulus is coming and that will just drive things up. So that can be an example of something that in the elections might shake things up a bit. Question from Miles. How do you maintain conviction in your long-term views when day-to-day so much of traders' chatter is so relentlessly optimistic? How do you stop yourself being too influenced by people who understand the situation less well than yourself? Another great question. So I would say in this kind of profession, there's a fine line between conviction and stubbornness. And it's kind of one that you're always on the fence and you're always treading that fine line. And it's very important to stay nimble. And that agility, that being nimble is the flip side of conviction and maintaining your same position, right? So to give you an example, as I mentioned previously, I had had this very long-term long equity, long tech, long the future conviction back from 2015. And those stocks did incredibly well. And I didn't see any reason to change that. So I was had a strong conviction in that. And then when the whole COVID situation started to unravel in February, that was where there was enough evidence that I was presented with that I actually had to shift that conviction. And that can be hard. So you need to be as objective as possible. So it can actually be useful to hear the other side of it, hear why people are optimistic, and then you can try and judge, okay, is this just naive optimism with no reason behind it, or is there something that I'm missing? You know, am I just on the wrong side of the trade? So it's hard. It's definitely the hardest part, the psychological part of trading. The second part of your question, like being influenced by people who understand the situation less well, is an important differentiator. And I apologize if some of you feel that I've been not communicative enough on eToro, but that would be one of the reasons that it can be hard when there's a lot of smart people and a lot of interesting comments, definitely. But there's also a lot of very uninformed, unhelpful comments that sometimes I need to shield myself from, just to protect the integrity of my views. So it's a balance between being exposed to the other side and always having a balanced view, and just doing your homework, right? That's all you can do. So I just try and I speak to some very other experienced, successful traders and bounce ideas off them, try and disprove my conviction, but just repeatedly look at the market and say, what is the case for the short side? What is the case for the long side? Look at all the pieces of data that you have and come to an informed conclusion. But yeah, it's hard. Another question from SA. Do you think we should pull out on our long trades, other traders, or personal trades? So it really depends on what your long trades are for. If this is like a 401k type thing, you know, like a long-term, very long-term plan, or if it's more speculative, if it's leveraged, if it's not, what instruments is it on? It's very hard to answer this kind of question just so broadly. It's good to be hedged. So copying someone like me and someone like J Nemesis, for example, or other people who are, you know, the top PIs who are very long, it's fine. You need to, I try and maintain my own portfolio hedged, so that even when the market is going against us, we're just kind of breaking even. But this is really where you need to take your own views into consideration as well. I would say don't just go all in short, even if you believe, even if your conviction is aligned with mine, because a conviction is still just a conviction, right? So a conviction means, for me, I'm leaning 70% this way. I can still be wrong. So you want to make sure that you have some exposure to the other side as well, just to minimize that risk and that volatility. So yeah, if you want to ask a more specific question, I can try and answer. If you have a lot of exposure to the very high-flying tech stocks, for example, I would definitely say be careful. But long on other things isn't necessarily bad. what made me choose to be a PI? So it was kind of an evolution. Like a lot of things in life, it's not often a conscious, clear-cut decision. So I started trading on eToro, just trading my own account. And then as I started to have more copiers, eToro approached me saying, would you like to be a PI? And then as things grew and grew, it became more of a serious commitment for me, let's say on par with my job a few years ago, which was in management consulting. And then as things really started to take off in terms of number of copiers and returns, then I just decided, okay, I'm going to do this full time because it's what I love, what I'm good at, and also so that I can put in the maximum effort for all of the people that are entrusting me with their money. But choosing to be a PI specifically, as opposed to being in some other hedge fund or something like that, is a very personal choice. So right now I'm at home. I live in the countryside in Portugal, and this is what I value most, the freedom to be able to invest how I see fit with no restrictions from colleagues or boards or bosses. I mean, obviously you have to trade sensibly, right? There are some restrictions on eToro, but if you do this in a hedge fund or in a pension fund, you name it, things like that, there's a lot of restrictions. And it's more like the life I used to have of getting up every day in London and getting the underground and, just things that I hate. I think is totally a waste of life. So being a PI allows me that freedom of expression, if you will, with my trading ideas, and also allows me to the flexibility and the freedom to actually live my life how I want. So it's a very personal decision, but that I think is great. If the market drops, next question, if the market drops as you expect, then what is the plan for when after this happens? So if the market starts to drop, I will open some bigger shorts like I had in March, and we will start trimming some of the longs, keeping things balanced. But broadly, it's hard to say because it really depends how it happens. There's so many variables. It depends on which part of the market drops first, how quickly is it dropping, what are other asset classes doing. It's very hard. But to give you a concise answer, I would say the risk will go up. So at the moment, we've had like a 3 or 4 risk level over the last few months, reflecting, the fact that the market is not going our way. So I'm not putting too many chips on the table. If the market drops, you can expect to see more of the portfolio invested, and a risk of 5, maybe hitting 6 at times, a little more volatility, but hopefully much higher returns as well. Another question from Jinesh. Why do you have so many realized losses instead of drawdowns? So this partially depends on how you trade. The way I trade tends to be open a position, set a stop, and then if the stop gets hit, that means that trade it's a very hard mindset to get into for someone who doesn't do this professionally. But a loss, as weird as this may sound, is not bad. It's just part of the plan. So it's inevitable, right? You always have wins and losses. So then once you accept that fact, which is just a reality of investing, you have to decide, how am I going to deal with my losses? And when you think about it, what you want to do is make them as small as possible. So if a trade is not going my way, I'll kill it. And that is a realized loss. And that is much better than leaving it there and thinking, you know, maybe I'll be right, or maybe it'll turn around, or doubling down, or all of these things that a lot of people do to avoid crystallizing, making that loss real. So yeah, that's the reason why. Next question. I get that you're bearish. By the way, guys, some of you might be shy, but if you want to have a conversation about any of these questions, feel free to unmute yourself, turn your camera on if you want, and that might give you a more clear answer, or give you the chance to, you know, have a back and forth. But fine if you want to have them in the chat. I get that you're bearish. I think there will be a big fall too, but would you consider following some other assets? You did so with silver a while ago, like commodities, currencies, etc., for occasional trades. So I do. The thing is that I only take trades that I think are a really good setup. So if I don't see any real opportunity in the market, then there's nothing to do. And that can be the case for a long time. And then suddenly something might pop up, like silver a few months ago, on which we do extremely well. But you never know when they're going to appear or how long they're going to last. So it's probably hard for you to imagine what I'm doing or thinking, but I am scanning charts and assets and all sorts of asset classes every single day, on the lookout for these opportunities. And unfortunately, they don't come along too often. But I want to make sure that one of the cardinal sins of investing is over trading. So you really want to make sure that you're just going for it when you have a solid reason to, and when you have conviction. And yeah, I think there's probably going to be some moves. The thing about these markets, like somebody said, is that they're very highly correlated. So there's probably going to be some big moves in Forex and commodities, I would expect, in the near future. But that's probably going to be at exactly the same time when the equity markets move as well. It might not be, but it could be. So we might kind of have a nothing, everything type of. So I've been closing some shorts on Apple and Amazon. How would you explain that? So that is just a, that was yesterday, actually, I believe. That is really just a tweak. So things do change, and I was looking, as I do every day, at all the individual charts, and Apple and Amazon just looked stronger than some of the other shorts that we have. And they had some breakouts that I'm not sure if they're going to actually materialize into a next leg up, or if it was just a daily thing. But they suddenly didn't look like the best shorts. And so going back to the question about why realize losses, you know, those shorts just weren't the best use of our funds anymore. So I just closed them, but still holding on to some others like Zoom and Tesla. And you know, if the price action on Amazon and Apple, etc., starts to look more bearish again, then we will short them again. Steve, I've often seen that you don't cut your losses in good time and eventually close the position when they're deep red. Also, many a time you do not book profits on time, and instead it seems you wait for the positions to turn from green to red. Well, clearly that's not what I'm waiting for, right? Like my goal is to have as much green as possible, just the same as you. But every trade has a certain risk reward profile. So if you see it, I might have set up a trade that has a stop loss at 100%, right? And the percentage doesn't really mean anything because it's just relative to the size of the trade. But let's say, for a simple example, that the stop loss is set at 20% of the position, and my goal for this trade is a 100% gain. If the position becomes a 20% gain, then I have basically put on that trade and that risk just to have a totally break-even situation with a 20% downside and a 20% upside. So I'm just going to hold that position and give it room to move up where I think it's going to go. And yeah, sometimes it becomes what's called a popcorn trade, where it just does a round trip, and I try my best to avoid them, but unfortunately sometimes that happens. And it works both ways. For the red trades that can then turn green, and the other way around. Do I speak Portuguese? I don't, but I do speak Italian, which is quite similar. Well, not that similar, but it helps. It is quite easy to get along with English here. If you go to Lisbon, yeah, almost everyone speaks English. Here in the countryside, a little less, but it's fine. I'm learning though, I'm learning. Hi, would now be a good time to add more funds to the portfolio since we're pretty red at the moment? Yeah, I answered this question before. If you want to listen to it in more detail, I believe you'll get the recording of the call. But in essence, that is a good intuition on your part. If you are aligned with my views and you have conviction in and trust in me, then yeah, it makes sense to add funds in periods that are flat or red. Yep. Do you believe in investing in mutual funds versus investing in PIs like you? Well, it's really a personal decision. So it totally depends on all of your goals. What are you trying to achieve? What type of return are you trying to achieve? What is your time horizon? How much do you want to be involved? Are you looking to learn? If you're someone who just wants to invest and you know that you're not interested in it and you're not gonna, it's for the very long term and you don't want to learn, you don't want to hear from anyone, then maybe you want to keep it simple and go with some kind of fund. Obviously keeping a close eye on the fees. Usually mutual funds are not the best choice for most people. Index funds can be better for a lot of people, but it's totally subjective. But I get the impression that most of you are actively interested in the markets, enjoy seeing trade by trade, interacting with me, learning as you go, trading yourself on the side. So I think yeah, it's a good thing to do. Are we running out of time, Tomo?
Yeah, George, exactly. So yeah, we're usually doing this for maximum of 45 minutes, but there were so many good questions. So I'll let you answer very carefully. So maybe you want to close things, say a few words, last few words. Maybe you want to say a few last words for the copiers before we end this call?
Yeah, okay. I'm just looking at the questions now and we answered pretty much all of them.
Yeah.
So yeah, thanks for all the questions, guys. It's much appreciated. It's nice to have a conversation like this. Thanks again for copying, and remember that this is a journey for the long term, so hold on tight. If you do want to reach out, please feel free to comment, and I will try my best to get back to you. Or if you have any other kinds of requests concerning these calls or interaction with me, you can reach out to Tomer, and he's in charge of kind of organizing all of this. So we can, it's really for your benefit. So we can tweak it to however you would like. So yeah, thanks a lot.
Great. Thank you, everyone. And,
Okay.
thank you, George. See you
Bye.
next quarter.
Bye.
Bye-bye.